Welcome all. Steve Parisi here for IBC Global's webinar in which we are going to cover an interesting topic, non-direct and direct recognition. And the question, what's the difference or does it really matter? So there are a lot of opinions and a lot of confusion around this topic as well. And the confusion, I will add, mainly revolves around direct recognition. Excuse me. So as we go through the material this evening, really the bottom line question is does it really matter what the company practices, if it's non-direct or direct recognition? And I will make a side note that it is very important to look at each specific company that practices direct recognition. And you'll see why in a little bit. So let's touch on non-direct recognition first, because this is a bit more straightforward and easier to understand. So how does it work? Well, a non-direct recognition policy does not recognize when a policyholder takes a loan and will not adjust the dividend. And when I say they don't adjust the dividend, they do not adjust the dividend credited to borrowed funds. So let's take an example. We'll assume that we have a policy with $100,000 of cash value, and we are receiving a 6.2% dividend. We're going to look at MassMutual's 2020 dividend rate here. So if I have a 6.2% dividend with a non-direct recognition policy, I loan out half of it. I take out a $50,000 policy loan. What's going to happen here is if I have a non-direct recognition policy, chances are very high that I'm going to have a variable loan rate associated with my policy. With MassMutual, that is the case. Now, the $50,000 I borrowed out, I am still going to receive a dividend on that $50K as if I never touched it in the first place, and that dividend will be the same 6.2% because the company's non-direct recognition, they don't recognize that I borrow, and I get the same dividend on any money in cash value and any money loaned out. Same 6.2. So really what you'll see with any non-direct recognition policy is if I pay into it, let it sit and grow, or if I borrow against it and pay it back, my cash values will be exactly the same when that loan's eventually repaid compared to the growth scenario. So we're going to demonstrate that as well, because I realize that may have sounded a little bit confusing when I mentioned it. So to simplify, with the example where I had $100,000 in cash value, I'm going to receive the same dividend on the full 100, regardless if it's all in cash value or if I have loaned some of it out. So non-direct recognition, in my opinion, is easier to follow because I get the same dividend regardless if I have everything in cash value or if I've loaned against my policy. Okay. Direct recognition. How does this work? Well, a direct recognition policy will not recognize, a direct recognition policy will recognize when a policyholder takes a loan out, and they will adjust the dividend credited to borrowed funds. So direct recognition directly recognizes that a loan comes out and the dividend rate will be adjusted. Now, you may have noticed that I did not say the dividend rate will be reduced. A lot of material out there that states that. Depends 100% on the company. You know, as a quick side note, let's touch on something important here. And this is good information to be aware of, whether I'm in the industry or if I am a consumer interested in a policy. If you've watched any of our content, you have heard me say probably 10,000 times the word 4 major mutual companies. Simple reason being is when you look at actual policies on the books, we've seen these companies produce the highest cash values. Now, tonight we're talking about non-direct and direct recognition. So, let's provide some useful information. Big Four are MassMutual, Guardian, New York Life, and Northwestern Mutual. What's interesting is New York Life is the only one that practices non-direct recognition solely, meaning their policies are issued as non-direct recognition policies. MassMutual offers both non-direct and direct recognition. We can actually select the option when we first open a policy. Guardian is direct recognition. As a quick side note, they do offer the option, you can opt into a non-direct recognition policy. You can switch your policy to non-direct recognition in the 10th year, or you can keep it direct, but we won't go into more detail on that this evening. And then Northwestern Mutual is direct. So you've got Mass, Guardian, and Northwestern Mutual, which either practice direct recognition or have the option to select a direct recognition policy. Most MassMutual policies are issued as non-direct recognition. And my opinion on that is because it's easier to understand, and their non-direct recognition policy, again, in my opinion, is a little bit more favorable to the consumer. But where I'm going with this, 3 of the Big Four offer direct recognition. We often hear, or I see a lot of material out there, that direct recognition policies lower the dividend rate on borrowed funds. Guess what these 3 companies do? They raise the dividend rate on borrowed funds. So for example, Mass for 2020 has a 6.2% dividend rate. If you borrow, and you're going to see this demonstrated this evening, if you take out a loan, we'll have a fixed rate of 6%, but guess what? We are going to receive on those loaned dollars a higher dividend rate than 6.2%. Guardian has a dividend rate for 2020 of 5.65%. They also have a fixed loan rate of 6%. If you borrow, Guardian credits you on the borrowed funds a dividend rate of 6%. Northwestern Mutual has a dividend rate of 5%. A fixed loan rate of 8%. If you borrow on borrowed funds, they pay a dividend rate of 7% for the first 20 years, and then it increases after that. Point being, here are direct recognition companies, not just one, 3 of them here, that raise the dividend rate on borrowed funds. Non-borrowed funds receive the same dividend. Great, invaluable information to be aware of. Now, again, every company has a different practice and things can change over time, but we know what we know, and it's important to have the information up front. This way, I don't get into a policy today and then find out 5 years later, hey, I would have went with option B, but so-and-so never told me about it. They just showed me one option. So let's get back on track here. There's the bonus material for today. Is with a direct recognition policy. So if I've got cash value of 100K, loan out 50, I've got a fixed loan rate. With most direct recognition policies, you will see fixed loan rates whereas non-direct has variable loan rates. The 50K loan, those funds still receive dividends. Could be higher or lower than the basic dividend rate, depends on the company. Unborrowed cash value of 50K receives the same 6.2% dividend as if I never touched the money in the first place. So to simplify, if I started with 100K and I borrowed money, I still receive dividends as if I had the full 100K in cash. The difference is any money still in cash value receives the company's dividend rate for that year. Any money loaned receives a different dividend rate, which could be higher or lower. Again, depends on the company. Major mutuals right now all raise it. Let's look at some examples here. So we're going to look at a non-direct recognition study first. We've got a Mass Mutual example up here. So before we just start whipping through the spreadsheet, let's validate some of the numbers. We're going to look at a Mass Mutual 10-pay this time, a little bit different than the traditional L100 product. Mimics very closely a 1090 split that we talk about all the time. By year 5, I've paid in $250, I've got $250. This is a growth example, just paying money in for 10 years, letting it sit and grow. Year 15, I've got $740,416 in cash value. Okay, that's great. Let's look at the loan example. Same policy, 50K going in for 10 years, and then taking out a $200,000 loan in year 5. In all of these studies, we are going to look at a 200K loan in year 5, and then paying back the principal and interest every year on that loan balance. Now, a big reason we put this on Excel is when we look at this sheet with loans coming out and being repaid, it looks a lot like stereo instructions. A lot going on the annual outlay columns. But main thing to look at here, and if you're watching this, you can go back and forth, you can rewind a bit to see the Excel sheet and these detailed illustrations just to make sure the numbers match with each other. But to simplify for you, year 15, cash value is that $740,000 in the example where we borrowed and repaid. Okay, let's go to the Excel sheet. Growth scenario on the left. 50 for 10 years, 250 by year 5, letting it sit and grow. I've got $740,000. Example on the right, exact same policy, and you can see that years 1 through 4, cash value and death benefit are identical. The difference is we are going to look at a policy loan here. $200,000 coming out. Now, when I borrow, here's how I'm impacted. My cash value is the equity that I have access to. That's the amount of money I can actually access. So I pull out $200,000. Now, the company is going to continue to pay me dividends and interest on any money in cash value and any money I loaned out. How and why they do that is they're going to collateralize my death benefit. So year 5, on the example where I did not touch the policy, let it sit and grow, death benefit is $2 million. The example when I borrowed out $200,000, dollar for dollar reduction, dropped by $200K. It's now $1.8 million. So how and why the insurance company continues to pay me the same dividend or dividends and interest on any money in cash and on any money borrowed is that they collateralize my death benefit. So if I die with a loan outstanding, they're going to pay the net death benefit out, the insurance amount minus the loan balance. Now, before we look at the repayments and what the values look like when it's all said and done, this is non-direct recognition. Year 5, when I borrow that 200K out, my dividend is what? $4,316. Year 5, on the example, when I don't borrow anything out, what's my dividend? $4,316. If we look at all the years that pass by, what's the difference? Nothing. If I look at year 15, the example when I borrowed $200,000, gradually repaid it over time, my dividend, year 15, $12,122. Year 15 on the growth scenario, same $12,122. So what this illustration is displaying is exactly how non-direct recognition works. I continue to receive the same dividends on any money in cash value and outstanding in loans. And as a result, when it's repaid, the balance is fully repaid. What do you notice about your cash value and death benefit on all years? 100% restored to exactly what it would have been as if I never touched the money in the first place. So the funds just continue compounding, yielding the same dividends regardless if I borrow or not. That's with non-direct recognition. That's with MassMutual. Next, we're going to look at a MassMutual product with their direct recognition treatment. Okay, this is where it gets interesting. So let's look at the detailed illustrations real quick here. Okay, Mass 10 Pay product. Annual outlay, same $50,000 for 10 years. Design is slightly different with this, just with MassMutual's rules to obtain the fixed loan rate. Cash value breaks even year 5. Very similar to the last example, mimics that 10/90 split very similarly to the non-direct recognition example. Year 15, you can see the consistencies here, same $740,000 in cash. Okay, let's look at the loan scenario now. When I borrow and repay, same 50 for 10 years. I pull out a $200,000 loan, and I've got the stereo instructions. Main thing to look at. Year 15 on the growth scenario, you may have noticed this already, was 740. Here's the loan and repayment scenario. And all we're doing is paying back the principal and interest. We're not throwing anything extra into PUAs, nothing like that. And what happens when I finalize the payback? The cash value is not 740,000, 753, almost 754. So let's look at the spreadsheet comparison. This will make things a bit easier. MassMutual direct recognition. Growth scenario first, 50 for 10 years. Crossover point year 5. Loan example, 200K loan out, year 5. Cash value is the equity I have access to. Death benefit is collateralized. Okay. Now here is going to be the key difference from the non-direct recognition example. And what's so interesting about this is this is the exact same company, exact same funding. We just changed it from non-direct to direct. Year 5, in the example where I pay money in, let it sit and grow, what is your dividend payout? $4,859. Year 5, when I have taken that $200,000 loan out, what do I see on my dividend payout there? $6,539. There's a difference there. Look at the next year. and the following. When that loan's outstanding, and even afterwards, I have a higher dividend payout. The reason why, what MassMutual is doing here, is any money in cash value, they're paying a 6.2% dividend rate on. Any loaned balance funds, they're still paying a dividend, but it is greater than 6.2%. So what happens now is when I repay my policy loan, let's first look at the growth example, year 15, $740,000. The example when I borrowed and then repaid everything in full, $753,000. So the direct recognition policy produced more cash value. Now, granted, I paid more in loan interest as well. I have a 6% loan interest cost instead of the 5% with the non-direct recognition policy. But it is good to be aware of this, especially if my understanding up to this point was that direct recognition just reduces your dividend on loan funds. Here we see that's not true at all. Let's progress on to our last sheet, Guardian. And let's validate everything first. So if we look at our detailed ledger, here we've got our 1090 split, 40-year-old male, 50 a year for 10 years, basic dividend option, 5K base premium, plowing everything else into PUAs. Break-even point year 4. All right, looks great, letting it sit and grow. Just to validate all of the figures, when we look at the Excel sheet, year 15, your cash value is $705,892. Okay, looks good. Let's look at the loan sheet, which I'll refer to as stereo instructions because the outlay columns lump together the amount you pay, the loan interest, the loan repayment. It's confusing. But you will see the cash values and death benefit and everything on our Excel sheet match everything from this detailed illustration, since we just pulled the values right after we generated it within the company's direct software. Okay. So let's take a look here. Annual outlay, $50K a year. Looks good. There's my break-even point year 4. When I look at the loan example, I pull out that $200,000 loan. Cash value is the equity that I have access to. Just like the non-direct and direct recognition example with Mass, death benefits collateralized, dollar for dollar reduction. Now what's interesting, you're going to see a consistency here with what we saw with the MassMutual direct recognition example. On the growth scenario, year 5, this is the example where I didn't touch the money, I just let it sit and grow. Your dividend was $3,302. In the example when you pulled out $200K, your dividend was $3,963. You received a higher dividend because you had funds loaned out. Here's exactly what Guardian does. Their dividend rate is 5.65% for 2020. They have a fixed loan rate at 6%. Okay? Here's what goes on. Any money in cash value receives the standard dividend rate, 5.65%. Any money loaned receives a dividend. We can tell from that dividend column, it's not 5.65%. They adjusted to 6%. They do that deliberately to match the fixed loan rate. They don't want policyholders to feel like they are going to be punished for borrowing from their policies. So we see two direct recognition examples today that demonstrate the company raising the crediting rate, dividend rate to borrowed funds. And the non-direct is a bit easier to follow because everything's the same regardless if I touch it or not. So know that is a decent amount of material to cover. If you have any questions at all, feel free to contact me, Steve, anytime you want. I'm Steve. Or our company directly by emailing us at info@ibcglobalinc.com, or you can call our offices direct at the number listed there. Hope this helps. Talk to you all in the future.